Hey guys, David Robinson here. Welcome to the apartment investing journey. Looking forward to the conversation that we're going to have today. Joined with me is Michael Brady of Madison 1031 Exchange. How you doing, Michael?
Good, good. How are you today?
Doing great. Thanks for taking some time to come and chat with our listeners about 1031 exchanges for apartment investors. And we're going to dive into that here in just a second. But for those of you that are listening, there will also be a recorded webinar version of this. And so feel free to go check out our YouTube channel. I'll also link to this in the show notes. And so obviously some of the slides that Michael's going to share with us today will be helpful to this conversation. We'll do the best we can with the podcast episode because I know a lot of you, most of you like to listen to our show via podcast, but just be aware that there is a webinar version of this available. So we'll link to that in the show notes. So Michael, with that being said, why don't you tell us a little bit about yourself and a little bit about Madison, and then let's dive right in.
Yeah, sure. So, my name is Mike Brady. I'm Executive Vice President for Madison 1031. Madison 1031 is a qualified intermediary for 1031 exchanges. So we help clients defer taxes using Internal Revenue Code Section 1031 and swapping one from one property to the other. My background is I am an attorney. I've been an attorney for over 26 years, predominantly doing real estate and corporate transactions, business transactions. And I joined entered the qualified intermediary space in 2005 when I ran the East Coast for a very large national qualified intermediary company. And I joined Madison about 2 years ago to head up some of the more advanced structuring for some of our advanced exchanges and do a lot of the presentations for our clients and for the general audience.
Great. Great. Well, I know that Madison is a larger company, and you have sister companies that provide a lot of different commercial real estate services. Maybe just give us a brief explanation of the services that Madison provides.
Yeah, sure. So Madison Commercial Real Estate Services is our kind of umbrella company that consists of 4 other real estate companies. As I said, Madison 1031, where I predominantly spend my time. We also have Madison Specs, which provides cost segregation services, which helps real estate investors accelerate their depreciation and reduce much of their taxable income, particularly in the early years of owning a property. And we have Madison Title, which is one of the largest independently owned title insurance agencies in the country. We insure title over all 50 states and pretty much have handled, everything from very small rental properties to right up into, several $100 million transactions in the New York and California area. And lastly, we have Lease Pro Due Diligence, or Real Diligence, I should say, which is our lease abstracting and financial due diligence company, which helps real estate investors kind of analyze their investments and make sure that before they buy and pull the trigger on closing on a property, that they know exactly what the financials are.
Wonderful. Well, Mike, thanks for that introduction. Tell us a little bit about yourself and Madison. Why don't we just dive right in and let's kick things off?
Yeah, sure. So I prepared a presentation today, which I call 1031 Exchanges for Apartment Investors. So this has some advanced 1031 exchange concepts, but I'll get into the basics as well. We'll start with Internal Revenue Code Section 1031, which is really where this all starts. That's why they call them 1031 exchanges. It's named after the Internal Revenue Code section. And it provides no gain or loss shall be recognized on the exchange of real property held for productive use in a trade business or for investment if such real property is exchanged solely for real property of like kind, which is to be held for either productive use in a trade business or for investment. Right? So that's all you really need to know, right? That's clear as mud.
That's right.
Yeah, if you're looking at the screen, you can see I've got a whole paragraph of text up there. It doesn't have any punctuation. There's no comma to catch your breath. And it does the one thing my English teacher told me never to do, right? It starts in the negative. No gain or loss shall be recognized. But if we break it down, it's pretty simple. Okay? To avoid paying taxes in the 1031 exchange, when we sell investment real estate, we have to trade it for other investment real estate. So for tax purposes, these are always going to be swap transactions. It's always going to be as if 2 parties were just trading deeds, and recognizing that if people did that, there would be no cash available to pay the taxes. And so therefore, In the 1920s, when the first, iteration of 1031 entered the tax code, they recognized that this was a transaction that should be, tax deferred rather than, taxable. That doesn't happen that often, and so we have other structures which we'll get into, but every transaction for tax purposes in a 1031 exchange will be a swap of one property for another. It's important to note, I always say that 1031 exchanges are not tax-free exchanges. Okay, sometimes they're advertised that way, and it's not accurate. They are a tax deferral mechanism, right? So you're only deferring the taxes, not eliminating them. You're kicking the can down the road till you ultimately stop buying property and you receive cash, at which point your accumulated gain would be subject to taxes. That being said, to defer all of your taxes in a 1031 exchange, you really need to just do two things. And you can do a partial exchange and pay taxes on a portion of the proceeds. But if you want to fully defer the taxes, you have to buy property that's equal or greater in value to the relinquished property that you sold. And you need to spend all the net proceeds or the equity from that sale. Okay, so if you do those two things, usually your debt will match up on the other side, but you don't have to take debt. You could come up with additional cash to replace the debt. So it's important to note you can do a partial exchange, but if you want to fully defer the taxes, just buy property or properties. You can buy multiple properties that are equal or greater in value to the property you sold and spend all the proceeds from the sale.
And how is value determined in that scenario? Is it determined based upon some sort of valuation and appraisal, or is it determined based on purchase price?
Yeah, and here it's a little bit of a misnomer when I say value. I mean price, right?
Oh, okay.
So, value is kind of a generic concept that, you can maybe determine through an appraisal, but really by value, I mean whatever you're selling for and whatever you're buying for, which truly is the value in the marketplace. Okay. So that brings us to our most common 1031 exchange. So I said, if you had two parties who just traded deeds, that's automatically a 1031 exchange, and you don't need me as a qualified intermediary for that. You just basically, trade your deeds and go about your merry way. Now, that doesn't happen very often. It's very unusual for two parties to love each other's properties that much that they just have to have it, and so they're going to trade, their deeds. Additionally, if they have debt on their property, the debt typically would have to be paid off because mortgages tend not to be assumable these days. So that happens very, very rarely. So what typically happens is you need a qualified intermediary. And the way that works, and that's what we are essentially. We are a creature of the tax code. The Treasury regulations specify that qualified intermediary is a disinterested party in the transaction. It's a person who is not, or an entity that is not disqualified for tax purposes, which would typically be an agent of the taxpayer. Okay, so we act as the qualified intermediary, and essentially the taxpayer exchanges with us. So for tax purposes, they give us their property, we sell it, we use the proceeds from that sale, and we buy a property from somebody else, and then we give that property to our client in exchange for the one they gave us. Okay, so that's what happens for tax purposes. But if you think about it, that would be a very, very cumbersome transaction, right? You'd have two deeds on each side of the transaction. The deed to the qualified intermediary, and then from the qualified intermediary to the buyer, and then on the other side from the seller to the qualified intermediary, and from the qualified intermediary to the taxpayer completing the exchange. So we have 4 sets of, recording fees. 4 sets of title insurance policies, which, Madison Title would love if we could do that, right? If we had 4 policies on, one exchange, that'd be fantastic.
Yeah, I bet.
And you'd have 4 sets of transfer taxes, and, the exchanges would be very expensive because for us to assume title to a property, there's some risk to us. So we'd have to price that into our fee. So what they've said is it's sufficient if we just take assignment of the contracts. The deeds can go from seller to buyer in each side, and the money has to flow through us. So by keeping the money out of the taxpayer's hands for tax purposes, it allows them to receive one property for the other. If they touch the money, it's too late, which happens from time to time. We have somebody, who get a call on a Monday saying, Mike, we want to use you for a 1031 exchange. And I'll say, great, when's the closing? And they'll say, well, we closed 2 weeks ago. And, I bang my head against the desk and I pick myself up and I say, I'm sorry, it's too late. You can't put the toothpaste back in the tube. You can't do an exchange. Once you touch your money, it's too late. Okay. So assuming they haven't done that, and the first thing they do is they contact us before they go to closing. We then do some documentation that has to be signed prior to the closing. When they're ready to close, the taxpayer will deed the property to their buyer, and the buyer will pay us. Okay, so we're keeping the money out of their hands. They then have 45 days to identify the property they want to purchase and up to 180 days to close on it. Okay, by identification, I mean they have to give us as the qualified intermediary, usually us, it could be the seller also, a list of up to 3 potential properties they're interested in buying, and they have to close on those properties or any of those properties within 180 days. There's some additional rules that apply, but in basic terms, that's what most people are looking at. Once they find that property they want to buy, they go to contract like they normally do. We take assignment of the contract to sale. When they're ready to close, we pay the seller with the proceeds we receive from the sale, and the seller deeds the property to the exchanger, completing the exchange. So you can see it's not that much different than your typical sale and purchase. The main difference is there's some additional documentation and the money will flow through us. Does that make sense?
Absolutely. One question I have in regard to identifying the up to three properties. Is there just a simple form that you guys have to identify those properties? Do you have to engage with a specific qualified intermediary prior to identifying those, or can you have a generic form that identifies the replacement properties and then engage with the qualified intermediary?
No, it's more important than that. The intermediary, qualified intermediary, needs to be engaged before you close on your property. Okay, so that's important. And then the way it's handled is typically if you close on Tuesday, we'll receive the funds on Tuesday. We send you a letter the next day. It says, "Dear taxpayer, we have your money, and here's a form to identify." And you fill that out, and you would scan and email, as usually what most people do. You can fax it, you can mail it, but typically it's scan and email is the way we typically get them.
And that 45-day timeline starts from the day of close, correct?
Correct. Both the 45 and the 180-day closing window start on the day of closing, or actually it's the day following. The day after is day 1.
Great.
Okay. And that's essentially a delayed exchange. We can do this as a reverse exchange. It's a little bit more complex. I'll give you the garden variety reverse exchanges. They tend to be like snowflakes. Everyone seems to be different, but the garden variety transaction, it's important to note, first of all, that you can buy your replacement property first, but you cannot own both properties at the same time. So typically what happens is you need to park title with us. We set up an entity called an exchange accommodation title holder, or an EAT for short. Okay, that'll be a single member limited liability company. Our company will be the sole member of that company, that entity, that LLC. And the way it would work is the exchanger would loan our company money. Okay, so to the extent that they were advancing cash to buy the property, instead they would loan it to us. They can also get third-party financing from a lender. The difference is we will be the borrower. Our entity will be the borrower. Okay, so this is not the easiest transaction to do, and so you can't do this at the last minute. You need to have ideally 2 to 3 weeks to plan this out in advance, because you have to get the lender on board. So once we borrow the funds, we then pay the seller, and the seller deeds the property to us. Okay? Then we enter into a lease with the exchanger for the replacement property. So while we are the owner of the property, the exchanger can use the property and receive all the benefits from it. They can sublease the property to tenants, they can receive rents, all that good stuff. Excuse me. They then have 45 days to identify the property that they want to sell, which is usually pretty simple, and up to 180 days to close on it. Okay? Once they find a buyer for their property, now it's a forward exchange, essentially. The exchanger deeds the property to the buyer pays the proceeds to us, just like, my prior example for the forward exchange. Now, essentially, they're acquiring the replacement property from us because we were holding it. So we will transfer the replacement property to the exchanger. Now we have this money that we received from the sale. Obviously, the taxpayer is going to want that. So We pay it to the taxpayer, but they are not receiving it as sales proceeds. Instead, it's a repayment of the funds that we borrowed when we acquired the replacement property. And so since it's the repayment of a loan, it's tax-free, as opposed to if it was sales proceeds, it would be taxable. Does that make sense?
Absolutely.
Okay. So these transactions are a lot more expensive than a forward exchange. Just to give you a ballpark, I probably shouldn't state fees, but you're talking about a couple $100 to $1,000, let's say, or maybe under $2,000 for a forward exchange, and reverse exchanges typically are several $1,000s depending on the size of the transaction.
And just from like a percentage perspective, how many exchanges do you deal with that are your traditional exchange versus a reverse exchange?
I would say reverse exchanges tend to be, it varies, on a tight market where it's hard to find good replacement property. We do a lot more of them because people want to line up their purchase first. I would say probably between 10 and 20% at any given time are reverse exchanges, and the balance would be the forward exchange.
Okay.
So those are our two types of exchanges, two general types. We can also use this parking arrangement to make some improvements to the property while we hold title to it and then get, further tax benefits from doing that. That's called an improvement exchange. So you can be somewhat creative in these structures. And that's why, again, it's really important to get the qualified intermediary involved early in the process, as well as your own accountant. So the accountant should be involved even before you decide to sell your property or buy a property. Okay, so now if you remember from section 1031, we said that no gain or loss shall be recognized on the exchange of real property held for productive use in a trade business or for investment if such real property is exchanged solely for property of like kind to be held for productive use in a trade business or for investment. So what do we mean by that? What do we mean by like kind? Does that mean I need to, if I sell an apartment building, I have to buy an apartment building? Well, the good news, my slides are a little bit out of order, so bear with me.
That's all right. You're fine.
Where is it? No, I'm missing slides. I apologize.
That's all right.
Yeah, we'll send out a.
I made you shorten up your presentation here.
I delete them. So let me just I'll do this very basically. So like kind property, when we talk about real estate, is very, very broad. So we can, sell an apartment building and go buy a farm. You can sell a farm and you can go buy a bunch of single family residential rental properties. You can sell your residential rental properties and buy an office building. You can sell your office building and buy a self-storage facility, right? So it's fairly broad what we mean by like kind. What it has to be, though, is the property has to be held for productive use in a trade business or for investment. So important. So what cannot be exchanged? The Tax Cut and Jobs Act of 2017, which gave us some things that were very beneficial to real estate investors, like opportunity zones, some other benefits for a bonus depreciation and some things like that. It did take away the ability to do exchanges of personal property. Before we had the Tax Cut and Jobs Act, we could do exchanges of personal property items, provided that they were like kind in a very narrow sense, which means we did exchanges of aircraft, but you had to buy aircraft. We did exchanges of, I did $100 million yacht for $150 million yacht, chartered yacht. I tried to convince them at the time as the qualified intermediary that I needed to spend some time on each of them to make sure they were like kind.
Obviously.
I figured a week in the Caribbean on each, just to be sure. Ultimately, they turned me down on that, and I just had to take their word for it. But that's the type of things that we used to do. We did personal property. But after January 1st, 2018, we can no longer do that. So again, what cannot be exchanged? Well, IRC Section 1031 limits exchanges to real property held for productive use in a trade business or for investment. What do we mean by that? Well, your primary residence is not going to qualify. The house you live in, if you're not renting it in any respect, is not going to be eligible for a 1031 exchange. There is a different rule that applies that allows you to exclude up to $500,000 of gain as a married couple filing jointly if you sell a property, your primary residence, if you've lived there for 2 out of the last 5 years. That's section 121. But otherwise, you could not exchange a primary residence. You could, however, do a split treatment transaction. We see this. We used to see it more commonly with multifamily houses. My grandparents, for a perfect example of this, they came over from Europe in the early 1950s. They bought a 6-family house in an area of Queens, New York called Ridgewood, an old German neighborhood, and they raised their 8 children in one of those 6 units and rented out the rest of them. They lived there until they passed away in their 90s. We would have loved for them to have sold that property and taken advantage of both sections. So they could have sold the property, taken the 121 exclusion on the value of their apartment, 1/6 of the property. And because the rest of it was rental, they could have done a 1031 exchange and bought a more passive investment. And my grandmother would not have had to be out sweeping the sidewalks at 80 years old. And, my grandfather wouldn't have been maintaining the fire escapes at, 85 years old with the circulatory condition. Ultimately, what we discovered, though, I think, was that it was taking care of that building amongst that and their grandchildren that probably kept them alive as long as they were. But they could have done that. Also, more popular now, we see Airbnb. And maybe some of your listeners are involved with Airbnb properties, and maybe they have a property that they use some of the time, or maybe they use one part of the property for their personal primary residence and rent the rest of it. And again, you could split that up. So you could take the value of where you're living and based on square footage typically, and exclude that gain as long as you live there for 2 out of 5 years, and then do a 1031 exchange on the value of the rest. We see that with the home office exclusion as well. Excuse me. Okay. To the extent that you've used the property personally, you would not be eligible for a 1031 exchange. So that's a split treatment transaction. There's a revenue procedure that your accountants can find called it's RevProc 2005-14 for those who are counting at home. It's a useful tool for many investors. That brings up the question of vacation homes, right? So you have these properties that you maybe you use them for your personal use. It's a house on the shore. I'm in the Northeast, so maybe somebody has a house on the Jersey Shore out in the Hamptons, or down in Florida, and Boca Raton's a big place. And people will often spend some personal time there, but they will also rent the property. Well, it's important to note that if you do not rent your vacation home, you could not do a 1031 exchange on it. There was a case that came out in 2008. I think it was 2007 actually, that disallowed a vacation home exchange where there was no rental use of the property. In 2008, they created a safe harbor for vacation home exchanges, which said that you could do an exchange of those properties. If you look at the 2-year period before the acquisition of a vacation home and the 2-year period after the, 2-year period before the sale of a vacation home and the 2-year period after the acquisition of a vacation home. And so during those 24 months, during each 12-month period, the taxpayer has to rent the property to another person at least 14 days out of the year at a fair market rent. And they may use the property no more than 14 days or 10% of the number of days the property is rented, which is ever greater. Okay, that is a very, very restrictive requirement, because if you think about it, to get 3 weeks or 21 days of personal use, you would have to rent the property out for 210 days, which, very, very few people will do. So typically, if you want to be safe, you want to stay with the 14 and 14, at least for the 2 years prior to the sale or the 2 years after the acquisition, to be within the safe harbor. It's also important to note you cannot play this game, right? You can't rent the property to your kids or your wife and say, I'm renting it to them and I'm going to stay there with them while they're there, but I'm renting it to them. Basically, they see through that. You can't rent it to a relative unless it's their primary residence. So you might be able to buy a college house and rent it to your kid while they're in college, and that could qualify, but it would have to be their primary residence.
Makes sense.
Okay, so there is some possibilities there, but it is fairly narrow. So what else cannot be exchanged? Well, 1031 exchange, 1031 explicitly excludes exchanges of property primarily held for sale. What does that mean? Well, no fix and flips. So if you have any flippers out there and you're thinking, wow, this 1031 exchange sounds great, you're buying properties and you're fixing them up for 6 months and then you're flipping them over, this is not for you. Okay, you're looking for trouble if you're doing fix and flips. not for developers. So if you're going in and you're buying vacant land and you're going to carve it up, first of all, if you had vacant land, you can do a 1031 exchange on it, no problem. If you carve it up and build 100 condo units, and then you're selling them off individually to buyers, well, again, you're what's called a dealer in real property, and you're not eligible to exchange those properties. Okay, same thing would go with a condo conversion. So as many of your listeners, I think, are apartment people, you go out and buy a 15-unit apartment building. If you held that for a couple of years and then sold it, you could do a 1031 exchange. If you instead decide you're going to add value and turn this into a condo and then sell off the units individually, it's similar to a developer. If you're condo converting, you should probably stay away from that. If you might be able to exchange some of the units, if you held some of them outside of sale and rented them for a period of time, that may bring them back into qualifying property, but otherwise just off the block after your conversion is complete, you should not be exchanging. So that begs the question, how long do we need to hold a property before we do a 1031 exchange? It's probably one of the most common questions I get. And the truth is there's no set holding period, right? The 1031 doesn't even mention holding period. It just has to say the property has to be cannot be primarily held for sale. It has to be held for quote unquote productive use in a trade business or for investment. But we don't really know what that means. So holding period is only one factor that would be looked at if you were audited. They really want to see that the property is held for investment rather than resale. So there's no set holding period, but it is the most evident factor because you have to state it right on the face of your tax return, right? When you report your 1031 exchange, it says, when did you buy the property and when did you sell it? And if both of those years end in 20, it doesn't take the brightest bulb at the IRS to figure out, well, maybe we want to take a look at this one, right? So given that, most advisors suggest the property should be held for a minimum of 2 years. And we base that on a couple of things. I just mentioned the vacation home rules has a 2-year window that they look at. I'm not going to get into the related party rules in 1031 exchanges, but there's a 2-year window that they look at there also. So 2 years seems to be relatively safe. Some advisors would say that as little as a year may qualify because that's when your long-term capital gains rates kick in, right? If you own the property for a year and a day, you get to pay capital gains taxes rather than income taxes, and that rate changes dramatically to 15 to 23.8%, which is the long-term capital gains rates with the net investment income tax, as opposed to income tax rates that could be in the 30+% range. Also, you'll be straddling 2 tax years. So now it says on your tax return you bought it in 19 and you sold it in 20, and maybe that passes the smell test a little bit better. Congress did at one point try to pass a 1-year holding period. That did fail, but it was something that they had considered. So that's more evidence that 1 year may be sufficient. Okay, but you also have what I call the Godfather defense, right? So there's a number of factors that come into play here. So if you had an investor who bought the property in January and they intended to hold it for a number of years and just rent it out and make good income, but they had some reason or somebody came along that made them an offer they couldn't refuse. And I won't do the impression because it's pretty awful. My Brando is not good. So they got this offer they couldn't refuse. Why should they not be able to do an exchange, right? So if they have good facts, they showed that they rented it. They had solid rental for 7 months. They had a good business plan in place. And then they got this offer. Either it was, somebody offered them double what they paid for the property, or maybe the person had some other leverage that made it prudent for them physically to sell the property to them, like in The Godfather. And I'm not talking about horse heads and beds or anything like that. But otherwise, they needed to sell the property. There's an argument if you have really good facts that maybe less than a year would qualify. There's some case law that suggests that might be the case, but realize that there's a good chance that you could be scrutinized if you're under a year. Here's the slide I was looking for.
There you go.
Let me just back up and say a leasehold interest as a tenant that of 30 years or more could be exchanged for fee interest, and that would include renewal options. So if you have a ground lease or you're a tenant with a 30+ year leasehold, you could sell that to somebody else and buy a fee interest in something else. And here's my diagram showing all the different types of like-kind property. I'll just also mention some other types. Very broadly, Delaware statutory trust and tenant common interests are pretty popular. We'll talk more about tenant common interests in a second. New York cooperative apartments have been held to be real property for 1031 exchanges. Development rights like air rights have been held to be like kind to fee interests. Easements, certain types of oil, gas, and mineral rights, as to mention air rights. And we've done some stuff with cell phone tower, long-term leases, and easements as well. Okay, so, excuse me, there is some creativity here in what's like kind. Just briefly to mention TICs and DSTs. So a TIC is, I'm not sure if your listeners would be familiar with tenant in common, but basically it's a form of ownership of property where you have multiple parties will own a piece of property and they will each be on the deed. So if you and I bought a property together 50-50, your name would be on the deed, my name would be on the deed, we'd be tenants in common, typically. There's also something called the Delaware Statutory Trust. These are typically sold from institutional companies to 1031 investors, specifically recognizing that 45 days is not a lot of time to find property. They've created kind of ready-made off-the-shelf investment property for people who want to do 1031 exchanges. Essentially, they will go out and buy a property in a trust set up under Delaware law, and they will sell beneficial interest in the trust to 1031 investors. And there's a revenue ruling that says that if you structure this properly, it will qualify for 1031 exchanges. This allows you to buy something with professional property management. You have to be an accredited investor, which means you have to have $1 million of net worth or $200,000 of income for the prior 2 years as a single person, or $300,000 as a married couple filing jointly. This is a little bit of a misnomer. Flexible investment amounts as low as $50,000. It's probably closer to $100,000. The financing is almost always non-recourse. And you have certain certainty of closure once you've been approved to buy this property. The downside is that these are not flexible investments. And so, you typically will need to consider being in the property for 5 to 7 years when the entire property would be sold, and then you'd be eligible to go do your own thing. So just know that it's out there. For somebody who's in a jam, can't find good replacement property, there are options out there.
And do you see that being a common strategy with investors to identify a DST as one of the 3 replacement properties as a fallback option?
We do see that. We do see people using them as a backup, and we also see people using them as a spread, right? So I mentioned what you need to do to fully defer your taxes. Let's say you were selling a property for $1 million, you found a property you love for $700,000, but you have a $300,000 gap. DST is perfect for that, right? Fill that gap and buy a DST.
Yeah, that Absolutely. Makes a lot of sense.
So I wanted to jump into some of the syndication issues because I know that these are of particular importance. So just a little bit of homework before we get there. So it's important to note that the taxpayer that sells the relinquished property has to be the same taxpayer that buys the replacement property. That seems simple enough, right? Every day, people are trying to get around that. They just don't realize that you have to have the same taxpayer. Legal title is only one factor. We always ask, who's going to show the property on their tax return? The taxpayer who's showing the exchange on their tax return is what I call the exchanger, the party doing the exchange. Could be an entity as well. Disregarded entities we use a lot. So sole proprietorships are not separate tax-paying entities. These are usually going to be limited liability companies with one member. Okay, they are viewed as the alter ego of their owner. They could have their own tax ID number, but they're not taxpayers. They don't file a tax return. Okay. So they are what's called a disregarded entity for tax purposes, excuse me. So the underlying member will be the taxpayer, even though the LLC owns the property. These are single member limited liability companies. The member can be an individual, can be a corporation, it could be a partnership, another LLC even. And you can sell and purchase in different disregarded entities, which is often necessary because banks may require you to buy in a brand new entity when you buy a replacement property. They want what's called a bankruptcy remote entity. They want an off-the-shelf LLC that has no operating history. So we make use of disregarded entities quite a bit in 1031 exchanges. Okay, issues arise, and this is going to be where you have this comes into play where you might have a syndication, right? That's now gone full cycle and they're ready to sell their property. Now, what do? Well, if the syndicate stays together, you can go ahead and do a 1031 exchange in that LLC, and there's no issue with that whatsoever. The problem becomes if somebody does not want to go along for the ride. Either they want to cash out, or they want to buy a different property. They want to buy into a different syndication. So the problem is if you just do the sale and distribute out cash to one of your investors, essentially what happens is the cash is the gain is recognized by the entire LLC. Everybody will pay a proportionate share of the taxes, regardless of the fact that only one party's getting the cash. Okay. And you cannot just have, that party sell their interest in the LLC because they can't do an exchange on that. You cannot exchange a partnership interest. That's different than a real estate interest. So you have to allow one or more partners to cash out upon the sale triggers, as I said, gain amongst all the partners pro rata. So we have to do one of a couple different things. Typically, the first structure that we look at is what's called a drop and swap. So prior to the sale, the partnership would distribute the property to the partners as tenants in common. Right? We talked about that. So everybody would have a deeded interest in the property. We should change the ownership structure and reflect it on our insurance policies, our leases, et cetera, et cetera. The tenants in common then are each separate owners of the property, and they can elect to either exchange or cash out and recognize the gain. They should enter in what's called a TIC agreement, tenant in common agreement, and look at Rev Proc 2002-22 if your accountant is curious as to where they need to look. The problem is the timing and holding period are the issue, right? So your partnership may have owned the property for 5 years, which is perfectly great for doing a 1031 exchange. If you distribute it out to the partners as tenants in common, they may only own the property for a couple of days or 5 minutes. And so have they held the property for investment, or are they holding for resale? The good news is the IRS, when they've challenged these cases, they've typically lost those cases. And so the IRS does not seem to be challenging these, although they certainly have the ability to turn around and do that. The bad side is many of the states that have income taxes, like New York and California, have looked at these transactions and have questioned them and challenged them. California just lost a very big drop and swap case. Doesn't mean the facts were kind of odd or kind of perfect, I guess, in a way that they aren't usually. So you can't rely on that. So you have to be really cognizant of doing these with short holding periods in states that have income taxes. The way this would look is as follows. So we have Ann and Bob are 50% members of the A and B LLC, which owns a piece of property. They decide they want to go separate ways. The A, B LLC deeds 50% to Ann, 50% to Bob, and they enter into a TIC agreement between them. Okay. Now they find a buyer for their property. Ann sells her interest and does a 1031 exchange, just like we saw before, and pays no taxes. Bob decides he wants to cash out. Bob deeds his property to the buyer. The buyer pays Bob. Bob pays the IRS. And with what he has left over, he goes and buys a cup of coffee. Okay, okay, assuming his Starbucks is open, and
that's right.
He must make sure he's socially distancing while he's in line and all that good stuff.
That's right.
So that's typically your drop and swap transaction. We could also do what's called a swap and drop. If we had these issues with the holding period, we had cooperation, the partnership couldn't stay intact, acquire replacement property, and complete the exchange. And then subsequent to that, the partners could refinance the property and cash out whoever wants cash. So your syndicate could do that. That might be more practical. Timing is still an issue. You don't necessarily want to do this the day after closing, but and you have to have the patience and the agreement of all the partners in order to do this. So what this looks like is we have the A and B LLC enters into a 1031 exchange. Let's say it takes 50% of the proceeds and it buys replacement property. Oh, actually, I'm sorry, in my example, it takes all of the proceeds and it buys 2 properties, okay? So at the end of the exchange, the ABLC owns 2 properties, and then Ann and Bob, who are the members of the A and B LLC, decide they want to separate. The LLC deeds 1 property to Bob, 1 property to Ann, and they go their separate ways. Okay, so that's pretty, clean structure. Might not work in most of your syndicates. Typically what you're going to see is some sort of refi to buy out the partner once out, or the drop and swap where you just get them out at the outset. It works a lot easier a drop and swap, the first structure I mentioned, if you're talking about minority, owners. They have very small interest in the property rather than, the bulk of the LLC distributing. It's important to note the partnership tax return does ask questions about these transactions. So even if the IRS isn't asking questions about them, they have the ability to kind of accumulate that data and do so. So now I want to get specifically into how to get into a syndicate with 1031 investors. okay, which I think may be helpful to some of your investors out there. So we talk about tenant in common, investment. So just holding deed to a property, many parties holding deeds to a property, does not make you a tenant in common for tax purposes. The IRS could still call you a partnership unless you basically structure it a certain way. So there's a revenue procedure out there that is submission guidelines to obtain what's called a private letter ruling from the IRS to characterize your structure as a TIC rather than a partnership. It's important to note nobody is actually going and getting the ruling. People are just looking at rev procedure because that's both time consuming and expensive. And so instead they're just looking at Revenue Procedure 2002 and basically structuring their transactions in accordance with the steps that, or the requirements that are listed in that revenue ruling. However, it's not a safe harbor. So it does not mean that the IRS will necessarily respect your structure regardless of what you do. There are 15 conditions for obtaining a ruling. Some of the, let me talk about what a syndication is, and I'll talk about some of the conditions for obtaining the ruling that are go up against some of our typical syndicate structures. So by syndication, what I'm referring to is numerous investors pooling their funds into a single real estate project. Generally, what we do is we set these up as limited liability companies that are typically structured as a limited partnership. So the syndicator who is setting up, who basically is doing all the work, is the general partner who has all the power in the transaction. And he or she will find passive investors who are the limited partners. They're just money interests in the project. They don't typically engage in management. Okay, so our syndicator. So we have a syndicator who finds a building and she wants to find investors. So the first thing she does is she selects a property that she wants to acquire. Her next step is she's going to find passive investors, right? People who are going to put up the money. She will also manage the property after the acquisition, and she, as a syndicator, often contributes very little or maybe even in some cases no capital to the acquisition. She's putting in the sweat equity, essentially. The syndicator typically makes money a couple different ways, right? So they typically will earn some money on the acquisition. They will earn a management fee for the operation of the property, and they'll get some equity participation as well. So they'll get a portion of the revenue after paying their investors a preferred return, and they will typically get a portion of the appreciation upon sale, right? I mean, that's typically what we're seeing in the marketplace.
Right.
People call it promotes, they call it waterfalls, there's all this stuff out there, okay? So how do we do this with a 1031 investor? Well, the problem we have is we cannot take a 1031 investor into the limited liability company for the reasons I mentioned. They'd be buying a partnership interest, which doesn't qualify. It's not like kind to their real property. And it's also just not eligible for 1031 exchange. So we could set this up as a TIC. The problem with setting up a TIC in a syndicated structure is that a TIC under Rep Proc 2002-22, certain decisions have to be made by unanimous consent, including the sale and leasing of the property, the financing of the property, and the hiring of a manager. Typically, your syndicator doesn't want those things to be subject to a vote. They want to run the show, right? They did all the work. They're, putting the sweat equity in, and they're managing. It also requires proportionate sharing of profits and losses, which means that your syndicator, if they're not putting equity in, should not be entitled to a share of the profits and losses in a TIC structure. Proportionate sharing of debt also. That's usually less of an issue, but also, if your TIC investor put in 25% of the cash, they need to assume 25% of the responsibility for the debt. Also, payments to any managers and a sponsor must reflect the fair market value of the services rendered, and may not depend in whole or in part on the income or profits derived by any person from the property. So usually, like I said, a lot of the syndicators' interest in the property or participation in the profits is dependent upon the profits and losses as well. Where typically a management fee would be just a flat fee. So it's not the ideal situation for a syndicator. So how do we get 1031 investors into our syndication? Well, we cannot bring them into the entity. Okay, so we have to say that from the outset. And I want to just also say that this does not make sense for very small investors. So if somebody's coming in with 5% of the equity, you're probably not going to do this for them. But if you have somebody, let's say you have 75% of your equity and the cash you need is in your syndicated entity, and you just need that balance at 25%, and you have a 1031 investor who wants to come in with their 25%. Well, what you do is you set up a TIC. So the 1031 investor and the syndicated entity will acquire the property together as tenants in common. So the 1031 investor will own 25% and the syndicate will own 75%. The syndicator can still manage the property. You can enter into a management agreement with the syndicator. She can manage the property. Now, we have those unanimous consent rules that we're afraid of. Well, in theory, you can get around that by having the syndicator be the manager of the 1031 Investors LLC. So she cannot be an owner or a member of that entity, but she could, in theory, be the manager of that entity and therefore have some voting protection. She can make the decisions on behalf of that entity. And then at some point, the 1031 investor could contribute their TIC interest to the syndicate. Some diagrams just to show you what this looks like. So we have a syndicated deal where Ann, Bob, and Cam join in the ABC LLC as a limited partnership. And they're going to buy 75% of the property as a syndicate. Okay, Ann is the syndicator. She is the general partner. She controls the show in the ABC LLC. They need that remaining 25%. They find Don, who's a 1031 investor. Don sets up the DLLC, which is a disregarded entity. That will buy the remaining 25%. And then the ABC LLC enters into a TIC agreement with the DLLC, and they own the property as tenants in common. Okay.
Got a question for you. So would this need to be planned in advance? I could see a scenario where you have a syndicator who's looking to do more of the traditional syndication structure with general partnership and limited partnership, but they run into problems raising the equity needed to close. They have a big 1031 investor that comes out of the woodworks. Can this be done more retroactively after the PPM's all squared away and all that? Or is this the type of thing that needs to be planned for in advance?
It kind of depends. You should definitely talk to Securities Counsel if you're doing PPMs and all that. So you could conceivably do it. You may have to modify your PPM, and I'm not really sure the process of that because I'm not a securities attorney. But yeah, it's generally better to plan it in advance, certainly. But if you wound up short and you need that additional cash, I don't see why you couldn't adjust things on the fly. Obviously, you're not doing this, the day of closing, but with a couple of weeks' notice, you could probably get it done. And you enter into that TIC agreement. It probably doesn't affect your returns too much for your passive investors. So I don't think it's a major headache there. But you could obviously give the ability maybe in the PPM at the outset that this could be a possibility. Yeah. So you enter into that TIC agreement, between the two entities. And then at some point down the road, let's say it's 2 years, if this is a multi-year project, Don can basically make his he can deed his interest, the DLC's interest in the property, to the ABC LLC, and then become part of the ultimate syndicate. Okay. The downside of that is that if you're 2 years into the project, you may only have 3 or 4 more to go, and then you're going to maybe want to unravel it to get out and do 1031 exchanges. But that's something you have to consider and to see if it makes sense. So that's typically what we're seeing. If people are doing a 1031 syndication, that's how they're doing it. So that's really it. That's all I really planned. Oh, I should mention corporations. If you have a corporation, if you're one of those people who's stuck owning a property in a corporation, we don't have a lot of ability to get you out of that and separate, because the distributions of an appreciated property from a corporation to its shareholders would generally be taxable in the first place. And so it's hard to actually do that without, paying some taxes. And so we don't really do a lot of corporations.
Gotcha.
Okay.
Go ahead. I do have just a couple questions that I want to touch base on that are sort of random. So feel free to close this out here. And then
so, that's really it in a nutshell. My contact information for those of you who are looking at the PowerPoint. I'm always available. I always say I want to be a resource for real estate investors. So even if there's a transaction that, maybe you're not looking to do an exchange for a while, or maybe, you're in an exchange and you have questions that you're not getting answered appropriately, I'm more than happy to answer those questions. Typically email is the best way to reach me. mbrady@madison1031.com. Our website has a wealth of information also. It's madison1031.com. I have a blog there called the 1031 Zone, where I'm on a monthly basis pretty much adding articles on various topics.
Great.
And that's all I have.
Mike, this has been great. Thank you for walking us through this and doing it. The slides are very helpful. So if you're listening to this on the podcast, make sure you go check out the webinar version on our YouTube channel because the slides will be very helpful to the discussion. One question I did have, we have quite a few of our listeners that are in a scenario where they're looking for smaller multifamily apartment buildings and looking to engage in seller financing. And so the question I have is, how does seller financing affect a 1031 exchange?
Oh, I had beautiful slides on that too, and I took them out.
Oh, dang it. I'm sorry. I made you cut it short. I apologize.
No, it wasn't you, it was me. So if you're selling a property and providing seller financing, is that the question?
No, if you're on the buy side, but let's say that the investor needs to be able to explain the process to a potential seller of a seller finance deal.
Yeah, so if a seller wants to do a 1031 exchange and they're providing seller financing, it does create some problems. So because you have to have the cash available to buy the replacement property. We went through that exchange equation. You have to use all your proceeds, and the note that you're giving to your buyer counts as proceeds. And so let's say I'll take a pretty simple transaction, $1 million property, and the seller's taking back $500,000 of paper, right? Seller financing. So the seller's only got $500,000 of cash, but they need to buy $1 million property. And I'm assuming they didn't pay. I'm assuming they didn't pay off any debt. Okay, that's a different story.
Right.
So,
right.
So the problem is they need to buy $1 million property. They cannot replace the note from their buyer by taking on a new mortgage. So they'll need to come up with an additional $500,000 of cash to replace that note. And that's the way it's typically done. Essentially what happens is the note at closing is made payable to us as the qualified intermediary, and the seller buys the note from us by giving us $500,000, and then they have their $1 million ready to go buy a property. And another way they could do it, this is really tricky, they could say to their seller of their replacement property, we're going to give you $500,000 cash, and we're going to give you our buyer's note to make up the $1 million. So that could work, and that's perfectly fine. The problem is, to a seller, it's a hard sell, right? To the seller, you're saying to him, not only am I not giving you all the cash, I'm giving you a note, and I'm not giving you a note on your property. I'm giving you a note on my property. So if you have to foreclose, you're foreclosing on my property, and you're not going to foreclose on me. You're going to foreclose on my buyer who you've never met, maybe. So I've actually done that a handful of times, but it's usually where all three parties know each other. It could work that way. The other thing you can do is you can make the term of the note, if it's a short term, if you just need some bridge financing, if the term of the loan is under 180 days and the seller gets paid before they need to close on their property, that could work also.
Interesting. Okay, great. Well, Mike, I don't want to keep you any longer than we have. I really appreciate you walking through this. If anybody has any questions, don't hesitate to reach out to Mike at the information provided. We'll also have his contact info in the show notes below. And Mike, again, thank you for taking the time, and I appreciate you walking us through this.
Oh yeah, thanks. This has been great. Thanks for having me on, and I'm looking forward to seeing it myself when it comes out.
All right, great. Thanks, Mike. Bye-bye.
Bye.